another episode of Policy and Profits. I'm EJ Antoni. I occasionally like to play an economist on TV, but more importantly, as always, I am joined by the one, the only trader extraordinaire, founder of Ascalon 6 Capital, Antoni Esposito. Anthony, how was your week, my man?
EJ, week's going well. It's definitely a busy week, but we're trying to get to the unwind of the Iran puzzle, which is becoming a little bit of a Rubik's cube, if you ask me. Markets are still on fire, and we're making our way. We're heading into May after a decent April, and it is nothing short of head down and focused on the screens every day. How are you doing? How's DC treating you?
It is crazy to say the least. I know we were talking off camera, as we have many times before, about how just the news coming out right now is it's ridiculous. It changes every other second, right? You get a story 1 minute, it is contradicted by another story the next. One government says this, another government says that. And it really is amazing how it's like nobody can get the story straight. And so it's almost not worth, in a lot of ways, trying to follow that news cycle, right? And I know you do this every day because of the nature of the model that you guys have at Ascalon 6. And I just have to try to do it more and more myself, of just keeping the head down, not listening to the news because it's not actually news anymore, and just paying attention to the data. And I mean, that alone is a full-time job anyway, so I'm probably better off. But that I think is just kind of the real challenge right now, is letting the data and the numbers speak for itself, and then trying to tell the best story you can from that data.
Yeah, no, it's a good point. I mean, honestly, I'll be 100% transparent. We had a wonderful March. April, we made money, we were up. But a lot of April is managing, as I put it in the monthly note, we're not only managing the assets and the investments, we're managing risk around those assets, right? So when you can't identify the risk and you can't quantify the effect of the risk, then it becomes very difficult to manage the portfolio. And what I mean by that is, if I know that the model is giving us certain signals and I know what market action it looks like. So here we have our mantra is model, chart, stick. So we're running off our model signal. We're checking our technicals, general technicals on the chart, and then we're trading off of certain sticks the way we have them set up. When the risk comes in the form of a random tweet, a random headline, two totally contradictory tweets, a statement out on truth that creates a 2% rally in the S&P futures in, I don't know, like a minute, it becomes really hard to manage that risk and at the same time be as big or as involved as we want to be. So what we've really done here is pared back on the sizing. So we've downsized, kind of like a volatility weighting, right? The more crazy things are, the smaller you want to be, because there's going to be that much more movement. And then there's been moments where we've just stepped to the side, and that takes a lot of discipline. It takes a lot of backbone to say, I'm stepping to the side. I don't know what the risks are here, but I know that they exist. So they're kind of like known unknowns and unknown unknowns. So it's been a real challenge. The headlines, to your point, have been pretty contradictory, pretty all over the place, and they've started to slow down as we came into the ceasefire-ish state of stalemate. My opinion is personally that the Iranians probably have more leverage than we expected them to have at this point. I don't say that, in a happy way. I just think that's the way this thing is unwound. And we've really started to focus on, obviously, energy, crude, Brent, nat gas. This is all headline news every day. Everyone's focused on it. We've watched crude go from 60 to 120, back down to 80, back up to 115, back down to 90, back up to 110. Like it is insane. I did catch your post out on your X over the course of the week, and it did kind of match one thing that I saw from Bloomberg. And we were talking, the Bloomberg hit had talking about exports at record highs, and this is your X post, which is perfect. Bloomberg was talking about exports of oil products at a record high last week from the U.S. Shipments rose to 8.2 million barrels a day, driven by a record exports of distillate fuels like diesel, 1 million barrels a day departing from the U.S. So we're talking about a major uptick in our exports. Your post talked about where those supplies were actually coming from. Was it actually production within the US, or was it actually from reserves? And I was shocked to see what you dug into here. So cut away all the noise, cut away all the headlines. How are we actually um, sending out this energy? What are these exports actually? Where are they coming from?
Well, they're coming from not underground. They're not coming from wellheads. They're just coming from storage tanks. Now, obviously, some of those storage tanks, like the SPR, are literally underground. The salt domes, right, in East Texas and Louisiana. But the point is that this is coming out of storage. It's not an increase in production. We just don't have the excess capacity anymore, and that's something you and I have talked about a lot, right? Especially with our friend Tim Stewart at USOGA. We don't have the spare capacity after everything we went through in the Biden years to completely replace a nation like Iran, or really all of the oil coming out of the Gulf. So because this is a global market, if we're going to keep prices down here, we got to try to keep prices down globally. We're taking all this oil out of private stockpiles, out of the Strategic Petroleum Reserve, and dumping it onto the market, really as fast as we can, to try to keep prices down. We're just trying to replace as much of that lost supply as possible. And so I understand a lot of people want to cheer the fact that exports are up, that we're setting new records there. That's theoretically great. It's great if you're producing more to fuel those exports. It's not so great if you're just dipping into your reserves. Anthony, you can kind of think of it as in terms of like a household budget, if you want to use a very rough example here, you can think of it as, why are you able to spend more money right now? Are you spending more money because you're out there with a second job and you're earning more, you have more money coming in to justify the money going out? Or did you just take a hammer to the piggy bank in order to spend more right now because your expenses have gone up for whatever reason? You're facing some kind of family crisis, right? So that's just the reality that we have to deal with right now, right? It's not that we have all this excess production. We're digging into savings.
So this is interesting, because one thing that I've thought, and I've read a lot of research on from brokers across the street, around the street, it seems like the expected floor for energy is elevated now and will be for the coming 6 to 12 months. Meaning, if our base case was $60 a barrel WTI before this event, the base case now may be $85 a barrel WTI. So the price floor has lifted and will stay elevated. Is this part of that? Is this because all of this has to be replaced, right? It's not like we can just ship this storage, these supplies out, and then they're not going to be replaced. It's actually creating more demand going forward. Even if there's not economic growth, we're going to need the oil to be produced in order to refill and backfill the supplies here and the storage here. And by the way, this is going on not only in the US, but it's going on around the world, right? We have storage and strategic reserves are not unique to the United States. Mm-hmm. Many nations have them, and many nations have started to dig into them. So there's almost like we're creating demand, artificial demand heading out, which is going to create a price floor for quarters and maybe years to come. Does that make sense?
Yeah, absolutely. So what's going to happen essentially, Anthony, is, because you're right, all these nations have huge reserves that they're dipping into. Japan's a great example, because they're so dependent on entirely dependent really on overseas oil, about 95% of which used to come from the Gulf. Now none of it does. They have massive stockpiles. So they're digging into those very, very quickly, but they're huge. So once the conflict subsides, once supply comes back up because the strait reopens, now the supply shock is gone, but now you go into a demand shock, because now there's going to be this huge increase in demand as all of these nations that have depleted their reserves need to refill them. So you went from one shock, a negative supply shock, which puts upward pressure on price, to a positive demand shock, which also puts upward pressure on price. So right now, the base case looks like, instead of a floor of about $60, it looks like high 70s. And okay, one of the indicators for that is you can look at the data from the Federal Reserve Bank of Dallas. And if you look at the different firms that have responded in their energy survey, the latest info shows that majority of firms are expecting prices are going to stay at least in the high 70s, if not higher, by December 31 of this year. So end of this year, you're looking at prices $10, maybe $20 higher than pre-war levels. And that just seems to be kind of the new floor for quite some time, because again, even once supply gets flowing again, it's going to be met with this huge surge in demand, and that's going to again keep that floor on prices.
All right, so let's talk about demand just for one more second, and then I want to move on to the weekly chart for the S&P. Is there any offset to that as far as demand destruction at the retail level? So, meaning as consumers in the U.S. and around the world, but let's talk about the U.S. As consumers in the U.S. back away from these products because the price has now been it's just off the charts. They're using less, or they're not using as much, or they're not using it at all. Is there any offset there with demand destruction at the consumer level?
So we are literally just starting to see that within the last week or two. In fact, for March, we just got consumer credit data from the Fed. Credit card usage exploded. And of course, that's people, if we look at the retail data that we have, it's very clear that is just people trying to finance higher gasoline prices, right? They're going to the pump every week. They can't afford to pay off the credit card, so that balance is racking up. That's literally all that is there. You did see increases in things like auto debt and student loan debt and a couple other types of non-revolving debt. That was part of the increase, but it's very, very clear credit card usage exploded in March, and it's very clear the reason for that was just higher prices at the pump. So that the story that the data tell, I don't think there's any other way to interpret it on that end. Looking at the month of April, for most of the month of April, it again looks like people continued buying roughly the same amount of gas and diesel. However, by the end of April and now beginning of May, it looks like the data is telling the opposite story, where now people are cutting back with prices being this high. I mean, you're looking at the national average of gas at $4.50 a gallon. Hasn't been that high in years. And obviously people were throwing a fit last time it hit that. So it is finally starting to really bite in terms of people's purchasing power and how much they can afford, how much they can spend on not just gasoline, but now other things as well. We are just now starting to see the consumer cut back, to answer your question. We're finally seeing that demand destruction.
Yeah, well, the last time it happened, everybody got blue and yellow flags and stood with Ukraine.
That's right.
This time, just as a side note, I find it really interesting that there is no one marching in the streets here, and no one protesting or demanding civil rights or civil liberties for the Iranian people, who are really stuck in the middle of this mess and have been tortured for decades by this regime. So the fact that everyone stood with Ukraine at $4.55 a gallon, well, actually, price of gas at the pump went higher during Biden administration when Russia invaded Ukraine than it did now. But I find that interesting. It's just a little tidbit for you on the relative difference between this war and Ukraine, Russia. All right, very interesting. I think honestly, as we move forward, the market obviously does not care right now about any of this. They don't care about the consumer. They don't care about consumer credit. They don't care about energy prices. They don't care about backed up demand and this raised floor of the cost of goods and services. I just think that in general, we got sucked right into this AI technology warp speed rally off of the lows. Very, very similar to what happened in 22 coming out of the Ukraine Russia low. That low bottomed out, in my opinion, and I've said this before, way before this event, that the AI story came to life at the lows of that market. And I think that really was a narrative that was put in place to get money and interest and liquidity back into the markets and back into these names, and it worked. Names like NVIDIA exploded. It was the new rage. I mean, I hadn't really heard about AI or AI investing until that point. And that did mark the bottom of that 20+% move down. We kind of had a real sell-off in a lot of the AI names. We had a software issue, private credit issue in the software space. Those names were getting killed. The semis were getting killed. Like, we had a real sell-off here in tech. And again, at the lows, we created this AI. Let's reinvigorate this AI story. And all of a sudden, you have semiconductor names and tech names that are up 50%. I mean, you have names that are up 300, 400% just in the past couple of months. It's really been insane. The run has been off the charts, and it is definitely fueled by blinders on. It's all tech. And I'll go into the chart in a second, but I just want to be really specific and give some facts about why I say that. The breadth of the market is not healthy. The breadth of earnings is not healthy. At this point, 50% of the run that the S&P has had is attributable to 5 tech names. 50% of the run from the lows is attributed to only 5 tech names for the S&P 500. So think about that. There are 495 names that are trying to pull up the rear on the second half of the run, and there are 5 names gearing up. Additionally, as we've gone through earnings, all the pundits that are on TV and pounding the table now and sitting up straight, ties nice and tight, they got their glasses all shined up, and they're talking about how great earnings are and how great, forward PEs are and how cheap the world is. In March, I didn't hear any of them talking about valuations. I didn't hear any of them pounding the table on anything. Everybody was very, very quiet. And now all of a sudden we have this explosion of liquidity and this kind of gamma squeeze up in the market. And everybody's a genius and everything's really cheap. So when you talk about earnings and they say, well, we were expected to have 12 or 13% earnings growth, we have 28% earnings growth. Just to be clear, 70 cents on every dollar of that growth is Mag 7. So 70% of the earnings growth that we're seeing is just Mag 7. Now, if you want to dig into the Mag 7 and talk about how incestuous that those earnings and those dollars are as they pass from one to the other in this circle of pass the buck, you could do that. I think that there's a massive amount of risk in this market. I think there's a massive amount of concentration in names that will become vulnerable. I'm not questioning AI. I'm honestly not smart enough to go into AI and what it will eventually become and what it will eventually do. I can't tell you about semiconductor production or how many semis they need or how much energy they need to run these massive, I don't know, but I can tell you that the concentration in the market and the incestuous flow of liquidity between these names is concerning. I will also say that, and there are a ton of statistics to go through, but I'll also say that the Shiller PE, the cyclically adjusted PE, is back well above 40. It's only been above 40 2 times in history, 1999, heading into the tech bubble, and right now, 25 into 26, and this moment. So all I would say is there's a ton of risk under the hood right now, and markets do what they do, and there may be more runway for this market to go. Very, very clearly there may be, but there's definitely risk not being considered. I will finish with this before we go to the chart. A lot of the flow in the markets right now has really been due to these zero data expiration options. There is a huge, I call it a gamma squeeze, but there's a huge reversion where the hedgers of these derivative products, these options, need to be in the market, and they're creating, I won't go into the technicals of it, but what is happening is you're creating a lot of artificial demand for equities and for stocks because of these zero day to expiration options. These things are literally gambling tools. They're not investing tools. I don't even know if I would call them trading tools. They're creating a massive artificial demand for stocks. As we get to the Shiller PE and these ratios, we're well above any other historical reading. Only 2 times in history have we been above 40, 1999 heading into the tech bubble, and 2025-26, which is right now. So I think we really need to be aware of where we are valuation-wise, what's creating the moves, this derivative kind of gamma push up, and whether or not there's a real demand for these equities to this magnitude currently. What I'd like to do, I'm actually getting, I'm starting to get some headlines come across right now. There's actually some possibly a re-escalation in the Middle East, EJ. There's some firing back and forth between what looks like U.S. ships and Iran, and we have Gulf allies who are actually firing at Iran right now. I'm not sure how that's going to affect the markets. They look pretty calm at the moment. We were down about 50 bips on the day. Futures actually just closed 50 bips on the day in the S&P, down about 1.4% in the Russell. Crude closing out at 95. So we'll see minor uptick there from where it was before that started to hit the tape. We'll see what happens with that. I think we'll wrap it up. Does that all make sense as far as what you're seeing in this market? I know you're reading the headlines, you're head down in the data, but the explosion up is not exactly as it's being built.
Yeah, Anthony, I think that makes perfect sense. The fundamentals, frankly, just aren't there. That doesn't mean the market doesn't have plenty of room to run. As you know, I'm preaching to the choir here, but it's not as if look, the unweighted S&P really tells that story, right? Like you were saying with the Mag 7 having such a disproportionate amount of carrying the weight here. It really, yeah. I mean, again, the fundamentals just don't seem like they're there to justify these equity levels.
Yep. Yeah, the equal weight. That's actually a great point. The equal weight actually has been very heavy, and the Russell's been having some trouble the past few days in particular. It has bouts of explosions up, and then it kind of struggles. So equal weight not performing anywhere near the S&P is performing, and that's because of this outsized contribution of the 5 to 7 names in the tech space. That all said, this is a continuation of the chart which we've been running now since end of January. We did have our downside targets of 6,600 and 6,400 laid out. That was on a breakdown in momentum, similar to what we saw in December of 24. We started to see that in November, December of 25. We hit our downside targets of 6,600 and 6,400. Again, this is on the front month S&P 500 futures, not on the cash index, so the numbers will be a little off. But that was the move percentage-wise. Magnitude stays the same. And then we saw this big bounce out, right? So as we look at the major move up, we got back above that 7,100 level, which was the prior peak and the prior all-time high. And on this weekly chart, you can see that explosion through. It's been nothing short of amazing. I mean, it's been a real move, and price is king. So it printed. What I think we can look at here is we want to start to, the momentum on the weekly has shifted to positive, and I have that highlighted with a green bar. That was the week of 424. There probably is upside or potential upside in the near term to 7,500, 7,550, which is just a retracement level or extension higher. I do think that we are going to face a spot, and on the shorter term charts, the daily chart in particular is showing a breakdown or divergence in momentum and trend with price, meaning the underlying enthusiasm and momentum is starting to break down as price has climbed higher. That's a negative divergence, and with that, we would expect some retracement in price, potentially down to the 7,000 level would be my first stop. I don't think it's the end of the world, and I don't think that we're going to crash at this point. I think that there may be more track to run to 7,500, 75 and change. But I would say that although the weekly looks positive and strong and may give us some track up to 7,500 for now, there is divergence underneath the hood on the shorter term timelines. That means that the enthusiasm, the momentum, the trend pushing price up is actually fading as price continues to run. One of two things will happen, right? Momentum and trend will catch up to price, probably not likely right now, or price will catch up to momentum trend, which means it will have to draw down, let's just call it 5% from where we are right now. So keep an eye out for that. Again, nothing wrong with a good old-fashioned bull market run. But right now, there are reasons to be concerned, as we highlighted. So everybody just be aware and be careful.
Trust the data, right? Trust the numbers. Do not be the last fool, right? That the whole, I'm trying to remember which account I saw it on earlier on X, but it was, this guy was basically saying like, look, I know the market's not going to do well. I know this is overblown. I know this is a bubble. But you better believe I'm in on it, right? And I'm going to try to get out at the last second possible, which is where the retail investor obviously always gets killed. And that's where, having a model like yours is so critical.
Yep. No, I appreciate that. And it really has been a guiding light for us. Again, we're we're on that model every day. We're making sure that we're within the calls, and then we're doing technical analysis around the model to make, to make rule-based decisions, which has worked out well. So at real EJ Antoni, thank you, sir. Appreciate the time, appreciate the insights as always. I'm at CMT_Anthony if anyone wants to check us out on X. The website is ascalon6capital.com. EJ, always a pleasure. Appreciate the time, man. Have a great night. I'll talk to you soon.
Pleasure's all mine, Anthony. Thank you, sir. Until next time.